To understand what's happening today, you have to travel back to 1971. That year, President Nixon severed the US dollar's connection to gold. Overnight, the world's reserve currency went from being backed by something finite and tangible to being backed by nothing more than faith. For oil-producing nations sitting on finite, irreplaceable reserves, this created an obvious problem. Why trade something real for something that can be printed endlessly? The answer came 3 years later in a quiet diplomatic arrangement between Secretary of State Henry Kissinger and Saudi Arabia. The terms kept largely secret for decades until a Freedom of Information request surfaced the details in 2016 were straightforward. Saudi Arabia would price its oil exclusively in US dollars. Those dollars would cycle back into US Treasury bonds. In return, the US would provide military protection and weapons. This became known as the Petrodollar system, and it was a stroke of financial genius for Washington. Every country on earth needs oil. Every country that needs oil now needed dollars first. This created what economists call structural global demand for the US currency, giving it an anchor even without gold backing it. OPEC, the Organization of the Petroleum Exporting Countries, became the enforcement mechanism managing oil supply among member nations to keep the dollar-denominated pricing system intact. It worked for 50 years. The architecture begins to shift. That original petrodollar agreement between the US and Saudi Arabia quietly expired in 2024, a moment that received far less attention than it deserved. Then, earlier this year, a significant disruption emerged in the Middle East. The Strait of Hormuz, a narrow waterway handling roughly 20% of the world's daily oil and gas supply, became effectively closed to commercial shipping. Every barrel from Saudi Arabia, the UAE, Kuwait, Qatar, and Iraq had to pass through that strait to reach global markets. When it closed, the economic model of the Gulf states stopped working. The math became stark, particularly for Saudi Arabia. Before the disruption, the country required oil revenues equivalent to roughly $100 per barrel just to cover basic government expenditure. With shipping routes blocked, economists estimated Saudi Arabia would need prices closer to $170 per barrel to generate equivalent revenue. Oil was nowhere near that level. In fact, the paper price in futures markets was being actively suppressed. The result, the world's largest oil exporter began borrowing at a rate never seen in its history, topping $100 billion in a single year. The leverage play here is where the story becomes genuinely fascinating. Gulf states, the UAE, Saudi Arabia, Kuwait, Qatar, collectively hold over $2 trillion in US assets. Treasury bonds, equities, and other financial instruments accumulated over decades of petrodollar recycling. When those countries began running low on dollar reserves due to blocked oil revenues, they found themselves in possession of an extraordinary amount of leverage. The UAE made its move with precision. First, Crown Prince Mohammed bin Zayed met personally with President Xi Jinping in Beijing. The following day, the UAE and China signed 24 separate trade and investment agreements, pushing bilateral trade targets above $100 billion. With that relationship publicly locked in, the UAE then sent a signal to Washington: if dollar reserves run critically low, they may need to consider yuan or other currencies for oil transactions. And they hold enough US assets that disorderly sale could destabilize American financial markets. Treasury Secretary Scott Bessent acknowledged the situation directly before the Senate, noting that dollar swap lines were needed to maintain order in the dollar funding markets and prevent the disorderly sale of US assets. In plain language, a Gulf state holds enough American financial assets that a forced sale would hurt the US economy, and Washington would rather extend cheap dollar access than find out what that sale looks like. Days later, the UAE announced it was withdrawing from OPEC effective May 1st. Why China is the patient winner, the UAE's diplomatic choreography, Beijing first, then Washington, illustrates something China has been quietly building toward for years. While the US operated on the assumption that financial dominance was self-sustaining, China took a different path. They bought copper mines, they built ports, they invested in rare earth processing, controlling roughly 60% of global rare earth mining and an even larger share of processing capacity. They constructed yuan-based payment infrastructure that now operates through clearing banks in London, Dubai, Singapore, Hong Kong, and Switzerland. They simply waited. The rare earth dependency is particularly significant. Precision manufacturing for advanced technology and defense requires minerals like tungsten. Without Chinese materials, replacement timelines for complex manufactured goods stretch to 5 or 6 years at minimum. This isn't just an economic constraint, it's structural leverage that shapes diplomatic decisions. Meanwhile, yuan-denominated commodity deals are accelerating. BHP, one of the world's largest mining companies, recently signed commodity agreements shifting to yuan-based pricing with Chinese state buyers. Iran has priced oil to China in yuan for years. India has experimented with it. Russia too. The alternative infrastructure isn't theoretical, it's operational. Gold, bonds, and the reserve currency transition. The deeper story running beneath all of this is a quiet but measurable shift in how central banks around the world are storing value. In 2001, the US dollar represented roughly 72% of global foreign exchange reserves, the financial safety nets that every central bank holds to back their own currencies. Today, that share has fallen to the low 50s. Still the largest single currency, but no longer a near monopoly. What's replacing it? Primarily gold. Central banks have been purchasing gold at the fastest rate in 50 years. The catalyst was widely understood to be 2022, when the US froze Russia's foreign exchange reserves, roughly $300 billion in assets that have been accumulated over decades. Every central bank on earth watched and drew the same conclusion. Assets held in dollars are held at the discretion of the United States. And the US had demonstrated willingness to use that discretion as a policy instrument. Gold, by contrast, cannot be frozen. It cannot be sanctioned. It doesn't depend on any counterparty's goodwill. The consequence shows up in US Treasury bond markets. Investors are still willing to hold American debt, but they want higher compensation for the perceived risk. When 10-year Treasury yields approach the 4.4% threshold, bond markets begin showing signs of stress. The pattern that emerged was striking. Each time yields pushed toward that level, US policy posture toward the regional situation softened. The bond market, in effect, was setting the boundaries of American foreign policy. The two paths forward, from a market's perspective, the situation presents two possible resolutions, and both carry significant economic risk. In one scenario, the regional disruption ends relatively quickly. Iranian oil returns to markets and Hormuz reopens. Oil prices stabilize, inflation pressures ease, and bond markets calm. This is what equity markets currently appear to be pricing in, an assumption of swift resolution combined with an AI-driven productivity boom lifting earnings. In the other scenario, the disruption extends, and here the compounding effects become severe. The Strait of Hormuz handles approximately 1/3 of the world's fertilizer trade, the nitrogen-based agricultural inputs that, according to demographic data, support feeding roughly 3.5 billion people beyond what pre-industrial agriculture could sustain. A prolonged closure means fertilizer costs flow through to food prices with a lag of several months. That lag hasn't fully arrived yet. 6 months of continued disruption would embed inflation deeply enough that bond markets may no longer accept the current trade-off between short-term stability and long-term risk. What this means for portfolios, several assets sit at the center of this realignment. Gold has historically performed well in periods when treasury bonds lose relative trust among central banks, and we appear to be in one of those periods. Central bank buying has been historically elevated. The ratio of market capitalization to GDP, adjusted for federal debt, has only reached current levels twice before, at the peak of the dot-com bubble in 2000, and at the 2021 everything bubble peak. Both prior instances saw markets decline between 25% and 47% peak to trough, with recovery taking 2 to 13 years. Both were notably strong periods for gold relative to equities. Oil is subject to both artificial suppression in paper futures markets and genuine physical supply constraints, a tension that doesn't resolve quietly. The US dollar remains the world's dominant reserve currency, but its share of global reserves has been declining for 2 decades. That decline is likely to accelerate as more commodity deals shift to yuan pricing and alternative payment infrastructure deepens. Bitcoin sits in an interesting position, treated by some investors as a non-sovereign store of value in the same category as gold, though with very different volatility characteristics. The bigger picture. What makes this moment genuinely historic is that the architecture being renegotiated was built in secret and has never been publicly renegotiated before. The Petrodollar system wasn't voted on. It wasn't announced in a press conference. was a handshake deal between two governments that quietly structured the entire global monetary system for 50 years. That system is now being renegotiated, not in secret, but in plain sight, in Senate hearings, in bilateral summits, in OPEC withdrawal announcements, in yuan-denominated mining contracts. The transition from one reserve currency arrangement to another has historically taken decades and caused significant disruption along the way. We appear to be in the early stages of one of those transitions now. Whether that ends in a managed gradual rebalancing or something more disorderly may depend on decisions being made in the next several months.